Mark Todd joins us from FIIG Securities in Sydney. Mark, what's the current state of play about the concern in Australia of some of those issues feeding through to our banks?
Good morning, Brooke. Yeah, there is a lot of concern about Greece and about basically the effect of the global economy on us. So we have to manage the evolution of the economy through the mining boom and the fact that might be a structural change or a cyclical change. But broadly speaking, I think everyone's focused on that Greek scenario right now, and that doesn't look good.
Are local investors showing any particular concern in terms of when you're looking at price action?
I think it'd be fair to say that the local investor is getting more cautious, and I think they're going to go into a more conservative asset. So it'll be cash or cash equivalent. So you're seeing some spikes in the equity market today. I think that's more like a trading perspective. I think we're seeing growth in people looking for, an annuity-based contract. So they're looking for steady income at the moment.
And in terms of the Greece situation, there's a long way to go, I suppose. What do you think are some of the key markers for local investors that they can maybe watch for?
It's a tricky one. It's very complex. I mean, it's will Greece default? Will they won't? I think you need to think of it more like it's a Clayton's default. They just can't pay their debt. So it's a question of who pays the debt for them. And so I think investors will be looking for the ramifications, the ripple effect of that bailout, whatever it becomes. So, we look for things like how will the ratings agency reply? How will they respond when somebody steps in to help out? So there had been talk about, not so much coercing, but encouraging the private market to help out with the Greek affairs. So that means the ratings agency will assess what's happened with those private entities. So if Goldman steps into the market and helps the Greeks out, they'll be looking at the Goldman's balance sheet. And more importantly, from our perspective, we'll look at what the regulator will say, and they'll say, in a moment of crisis, how did the market react? And how do we try and create an environment where we don't see this sort of crisis, so that people can have consistency in earnings, and they just want this volatility out of the market. At the moment, it's just too much volatility and uncertainty. So we've heard you talk about Greece, we heard United States. It's a real issue for the market and the regulator, how they respond to make sure that their existing environment is a stable environment. So it'll be pressure on banks again.
So you think further reforms even to come out of the European situation?
I think it's more that they'll be sticking to the letter of the law. So when Basel III comes through, there is some room for interpretation. And so if the regulator says, well, the interpretation is I want that in a liquid asset, I really mean liquid. I want it in governments. I don't want it in supranationals. I want it in cash or cash equivalent. So I just think there'll be more prescriptive in the way they respond. Normally a regulator is a little bit looser in respect of, well, I can see your case and I'll accept that case. I don't see that happening. I think they're just going to say, we need to make sure the system is supported, and all your international commentators have been talking about the same thing, keeping the system rigid.
Yeah, it's interesting because I guess the backlash from the financial sector is getting louder and louder and louder on some of these Basel requirements, and in the past week JP Morgan's taken it to Congress. They say they're becoming uncompetitive, and it's actually too harsh. But you're saying perhaps we could say the harsher the better. Maybe not for the JP Morgans of the world, but
So I haven't seen a case where JP Morgan will go to Congress and say, listen, can you make it tighter? I mean, it's a standard. Listen,
no, they said they're going to become uncompetitive, particularly against the European banks.
Correct. It's a standard response. We'll be uncompetitive against the rest of the world, and I don't know how much percentage of their revenue is going to come out of the United States versus Europe. But the reality is, it'll be fairly deaf ears. I mean, I don't see a situation where Congress is going to be supportive of the banks, and I certainly don't see a situation where the European governments are going to be supportive of the banks. They're going to say, we don't care, because they have to appeal to one person, and that's the elector, the voter. And you can see that, as the Greek government tries to get its affairs in order, the people are, protesting. They're part of the problem. And so, as a foreign regulator saying to the Greeks, this is the austerity package, they would be looking at them from the political side and saying, well, I understand what you're saying, but I can't actually implement it because, people won't work. It's about getting the Greeks to go and work and then pay receipts. And, you just can't say, okay, this is the new law, make them go and do it. People don't work that way.
Can I ask you about the RBA then, and how this fits in, given we did get the statement from the RBA yesterday? Perhaps all of the Greek situations maybe escalated a little bit since that statement was actually put together. But to what extent do you think what's happening in Greece will feed into the RBA's decisions on the timing of the next rate hike?
Yeah, I heard Cam's comments prior to coming on, and I think that if you step out of the heat of each individual word and you look at the RBA's job, they've done a pretty good job. And I think if you looked at November of last year when they put the first rate hike in, they've said this is the trend that we're expecting to see, and I think it's sort of within their ambit. They think it's happening in the manner they thought. I always felt that the RBA thought it would be at the end of the year before they moved. That's what I thought. And I think the RBA is saying, well, we prefer to not have to move. So we'll be looking for a few things. The key comment that I saw from the RBA through the course of this year is the view that we aren't in a cyclical commodities boom, it's a structural change to the economy. And I think it's a really important issue that people need to focus on. Do we need to rejig the entire economy to adapt to the mining boom that's more permanent? And that's a significant event for people to change. And so the RBA will say, I need to use monetary policy in a judicious manner if I'm going to change the way the whole economy starts to work.
And what's supported by fiscal policy, no doubt, if that kind of,
sure.
The extent of that rejigging, what would that involve?
Well, I think the RBA's spoken about the fact that, for me, the key will be the currency. So they've spoken about the fact that the currency might start to settle on a more permanent basis at, above parity, so 105 or whatever, there'll be some movement around. And if you were to look at, farmers and you're looking at business models that people had historically built their business on, they would have thought before, China exploded in the way it has and the way America has declined the way it has, that the Aussie US would have been closer to 75 cents. So, you open up the paper today and you'll see the Fin Review, or people are, digging up their orange fields and, ploughing them back in because they can't, export. So if you think that that's now going to be 105, what does the business look like? So how's tourism? How's the Gold Coast going to be? How do we as individuals react to that higher currency? And it affects everyone. It affects you in your retailing. It affects you in your travel. It affects you in your export businesses. If cost of goods, you're importing inflation. It's a big deal. And if it happens for years, we're going to have different industries that'll work in a more meaningful manner around that 105. So you see bookstores closing down because you can get it online from Amazon. It's a tricky environment that the RBA is very conscious of, and they're trying to manage us through that as they take mining receipts and disperse them through the more broader economy. They're saying you need to adapt to the mining, and that means providing services to the mining and moving labour. So if it doesn't work on the farm, you've got to go to the mining. And so you're saying to people in areas of New South Wales, you need to go to Western Australia. That's a cultural issue. That's a big deal. And they're saying, well, the numbers say you need to move. Well, the RBA is smart enough to say it's going to take a little bit of time to move that over.
So, and are you suggesting that the RBA then almost, if it's that conscious of the currency, does it almost kind of target certain levels or make decisions around certain levels? How does that change its focus specifically?
Well, so there's two things about it. One is it looks at the effect of it moving its cash rate from 4 3/4 to 5, and it has an expectation where will that move the currency to. And if it moves it to say 112 and that stabilises at 112, it then says what's the impact to our exports? What do we think will model that movement? So that these are very statistically driven analysis, and so they can model numbers in and say, well, what happens at 112? What happens at $1? What happens at 80? What happens to the more broader economy? And I think if they look at 112, they'd say, this isn't happy. We will not have a lot of people pleased with that.
Mark,
so
Todd,
they've got lots of room not to do it.
Yeah, fascinating discussion with you again. Thank you so much.
Pleasure.
You have a great day. Mark Todd from